Hello. Today we are talking about chapter 2. Actually, we are going to cover frauds. So if we recall last week, in last chapter's class, we mentioned audit function, right? Audit risk equals to inherent risk multiplied with control risk multiplied with detection risk. And we're going to cover those risks one by one, but let's first interpret what it is. So audit risk is defined as the probability that the audit opinion given is wrong. So when we talk about auditing process, right, auditors are auditing financial statements, and when they look financial statements, right, they check basically whether the financial statements are prepared in accordance with GAAP, generally accepted accounting principles, and whether the numbers presented by the companies are truthful or not. Right? And if it's not truthful from the perspective of auditors and their material, meaning that the difference could be misleading those who use financial statements, auditors would be considering their opinion. Right? So in street language, we are saying that basically, if the financial statements are fine, they tell people the financial statements are fine. Right? If the financial statements are not fine, then auditors tell those who read other reports, other opinions, saying that the financial statements are not fine, and in what accounts perspectives are those financial statements not fine, those numbers not fine, and by how much, right? So this is audit opinion. So imagine this, right? Auditors do all their work, and they're going to be giving their product as a piece of paper stating their opinion about financial statements. So those who pay auditors for their service, and those people who use financial statements, they look at audit reports, and they inevitably, using kind of hindsight, based their decision, decide whether auditors are good or not, based on the opinion whether it's accurate or not. Right? So there's a lot of responsibilities on auditors' shoulders, and auditors, they are very, very concerned with making mistakes, because making mistakes usually cost a lot. Right? Every year we would have some, not really news, but auditors settle some claims against them with some folks outside the court, right? And if we go back, one of the most famous cases would be Enron case, which was a Houston company, and Arthur Andersen, one of the big five, went bankrupt because they were auditors of Enron. Right? So making mistakes could cost a lot. And in audit profession, what is making mistakes? Giving wrong opinion, right? Being wrong or terribly wrong. So that's pretty bad. Right? So financial statements, the misstatements, where the numbers are not truthful, we call those misstatements. So misstatements cause financial statements to be not truthful, and they are enemies of auditors, to say the least, right? So if we think about this, right, what could cause misstatements? Misstatements could come for two different reasons, right? One is when people unintentionally make mistakes, right? We call them error. Right? The other type is when people make mistakes intentionally. Right? What do we mean by unintentionally? Basically, like you're careless, right? You try to key in a number because your thumb is too big, your finger is too big, or whatever reason, you're supposed to put a 5, and then you put the number next to it. Could be a 4, could be a 6, right? And then when you are inputting numbers into ERP system, right? For example, you are inputting some numbers from paper-based invoice, and you become careless, right? You put the digits one way ahead and one position behind. Or you add 0, or you delete a 0. Those could happen. But if we know what do we mean by unintentional, we have to agree that usually those misstatements could be overstatements, could be understatements. They could be very small, they could be very big. So on average, those misstatements should have 0 impact on financial statements statistically, right? And plus today, I don't know how many people recall, right? So for example, let me ask you, when you log into your Blackboard accounts, what are you supposed to do, right? You put your username, you put your password. If you become careless and you put like your student ID wrong, or account number wrong, or account name wrong, Can you log in? Probably not, right? Or if you're supposed to use capital, but you use the lowercase, would you be able to log in? Probably not as well. And today's financial statement, financial accounting reporting, financial reporting system is smart too, right? So for example, when we have a journal entry like a debit cash, credit sales, cash sales, right? In a big enough company, in a reasonably sized company, two accountants do this job. One would be booking the entry, debit side, debit cash. The other would be dealing the entry, credit sales. So for the same transaction, debit side has to equal credit side. So it's very, very rare, if not impossible, that the two people make the same mistake by the same amount. Can we see it? So we are saying that unintentional misstatements from unintentional mistakes that are unintentional, they are not really of a big concern to auditors or to the company, because not only that by definition, they are not supposed to mean anything statistically, but also that from today's corporate management, corporate system perspective, it's almost impossible for companies to, especially accounting-wise, to make such mistakes. And since we talked about unintentional, there must be intentional mistakes, right? Intentional misstatements. What do we mean by intentional? Meaning that those who commit misstatements must have a clear purpose behind it. And what would those purpose be? Let me ask you, right? Do you think that the purpose would be to benefit the companies? Of course not, right? We never heard anybody commit a fraud to make the company better. Usually it means take something and to benefit themselves, right? And if we recall the fraud, whatever we have heard, those intentional misstatements, and we put them into two categories. One we call asset misappropriation, right? For example, people steal from the company. There's always rumor, cashiers skim cash, right? And those who are supposed to keep an eye on warehouse take some stuff back home, right? Those we call asset misappropriation. Also, it includes, right? You really like the working environment of your company, you like their chair mostly, right? So what you do is you take the company chair back home and put your $20 chair to the company, to your workplace. This is called asset misappropriation. Can we see it? Right? So type one is first type of intentional misstatement is asset misappropriation, right? And if we think about the second is a little bit more severe, right? It's called a financial statement of fraud or fraudulent financial statement reporting. And why it is, what's it, right? It basically tells, because nowadays when we look at the publicly traded companies, and we know that they announce their financial statements publicly, make them available every quarter, every year, right? And investors, those who invest in stock market, they rely on those financial statement information to make their decisions, right? If I see from the financial statements the company's future is going to be better, I might buy more. If I don't trust their future and if I think their price is too high, I might sell, right? So people rely on such information, and some companies, some people in some companies, right? They may have different intentions, right? Hey, I'm not doing very well last year, so if people find out, I might lose my $1 million job. So let me window dress, let me polish my financial statements. We made profit of 1 million. Let me call it 1.5 million to make it better, so I can keep my job, right? So they cook the financial statements. And also another example is that people do this. So we know everybody heard of stock options, right? Managements, high-level managements, usually their annual compensation includes stock-related compensation, right? What it means is that the stock price goes up, they will be paid more. So there's always somebody, they see that, okay, my company is doing good, or not even good, but it's not good enough, right? So how to make myself richer? Let me cook my book to make my financial statements look even better than it already is, right? So if we announce such information, right, then our stock price will go up, so my compensation will be fatter, okay? So if you compare to those compare those two types of fraud, right, of misstatements, which one do you think is more harmful? I would say that the latter, fraudulent financial reporting, could be more harmful because think about it. Let's interpret it from two perspectives, right? When we talk about the first one, asset misappropriation, right? We are basically saying that somebody steal from the company. No matter it is cash or it's some type of assets, normally speaking, they are not supposed to be very large amounts. And they only took place in the company, within the company, right? So it's not like really damaging a lot of people, and they can be handled internally. And to be honest, given the modern company's management structure, there's no one possibly steal too much cash or too much asset. And losing for most mid-sized companies, losing a couple 100,000 is nothing. Doesn't hurt so much. It's bad, but doesn't hurt so much, right? Not to mention lose a chair, whatever stuff. Okay. On the other hand, fraudulent financial reporting is really to the detrimental of the company. Why? Because financial reporting is to the public, right? And if somebody from the company commits such fraud, meaning that this person can influence financial reporting, meaning that they are usually high-level employees, management people of the company. So it's eyeball catching, right? And because financial statements are released to the public, to the stock market, so there are potentially tens, hundreds of thousands people can see it, and it can be misled. So almost a class action lawsuit is guaranteed. And also SEC, because it involves so many people, SEC keeps a close eye on this type of action, and they will sanction the company. The company's stock price could be dropping a lot. And lastly, but not least important, not unimportant, is that if you think about it, right? If you think about the management of a company, given their paycheck, they probably don't care much for stealing some assets from the company, for taking some assets back home. And they don't care too much for just getting maybe 200,000 cash, steal it, right? But they still, a lot of people still commit fraudulent financial reporting. Why? Because they benefit much more from engaging in such activities, and those type of activities, of course, if it benefits them so much more, they would hurt the company at least as much, or even worse. So as auditors, we need to understand we need to understand fraud, right? We need to analyze why people commit frauds, what is their rationalization to make them better, and what induce them to do such, right? Now, why do we learn this? Of course, it's not the purpose not to teach us to commit fraud later, not how to get caught, but we always say that keep your friends close, keep your enemies closer, right? To catch fraud, we must understand fraud. And that's why we analyze this. And we will also see that stopping fraud, right, is the company, the owners of the companies, they have strong interest in stopping fraud, preventing fraud, catching fraud, as much as auditors, right? So only if you learn why people commit fraud, what gives people opportunities to commit fraud, and how people rationalize, right? Companies can build a system to stop fraud, which we'll talk later. And also auditors, they know where to find fraud. Okay, so today we're going to take a more deeper look into fraud and into fraud triangles, which we'll talk about. And in the next chapter, we're going to talk about the corporates as the internal control over financial reporting from the fraud prevention and the fraud detection perspective. Right? We learn fraud, so we can learn. We can see what system we have to use to prevent and detect fraud. We're not going to eliminate fraud as long as people are still selfish, as long as the system is not perfect, still run by human beings. There will always be fraud, trust me, right? But what we can do is to minimize the occurrence, the odds of it, all right? So let's take one more look, okay? So when we talk about fraud, right, like all of us, I think that most of people, humankind, we are nice people. hopefully. And it's not easy for us to commit fraud, right? You go to the shop, right? You really like that purse. It doesn't mean that you will commit shoplifting. It takes something to commit shoplifting, right? So, but it's important for us. I mean, but we have to admit, right? There are difficult times and there are different needs which might push people to do that. So it's important. Okay? One example I would use is that it was quite a few years ago. Okay, I was looking into, I was reading some news, and there was an employee who committed fraud, basically stole a lot of cash from the company by signing checks to himself, to herself. And when people asked, hey, why did you do this? Right? She told the people, she told the folks asking that I've been working with this company so hard, right? Since when it started. Right? I work hard every day, giving everything to the company, but because I'm not the kind of person who want to talk nice, who likes to take credit, right? I don't get promoted that much. And I feel this is what I deserve. This is one thing, right? And the other news I saw was actually took place in Sugar Land. It was about 15, I believe, maybe 20, 15 years ago. And there was a family-owned company in Sugar Land, and there was a lady working for it. She really worked hard, and the family rewarded, the owners rewarded. She was like the talk-to guy regarding accounting. She was handling all the accounting issues, handling payments, handling cash. And you know the issue, right? You're handling accounting, which basically records transactions, including cash, and she was handling cash as well. She was given too much control. And what happens? One time she took a vacation, and the company had to hire some temporary help, right? The help realized something weird. There were a lot of payments made to some non-existing companies, which could be linked. Later, they found a link to the lady, right? And so then they were shocked, although the lady always dressed, mid-class and drive middle-class car, right? The lady actually owned a pretty fancy house with hundreds of nice high heels and quite a couple of nice luxury cars. And to this, right, this lady was not like unrewarded, right? She likes the environment, but she was given too much opportunity. Okay, so we learn all this. So let's analyze it. So for each fraud, we look at a fraud perspective. We said fraud could be, we can dissect fraud into three things: opportunity, incentive, and rationalization. Right? Opportunity basically is about, hey, what does this company lack that give those who commit fraud such opportunities? And incentive is what makes those people to commit fraud. Like I said, on average, nice people like us, we don't just commit fraud. We don't just take somebody shoplift when we see something nice, right? Even if we don't have money for it. And the rationalization is basically says, okay, what do people do to make themselves sleep at night, right? So basically, we three perspectives, right? And we can also, from a company's perspective, from a fraud preventer or detector's perspective, we can basically say that learning these, we can figure out, hey, how do we minimize the opportunity to let people commit fraud, right? How do we give people no excuse to commit fraud? Now, how do we make people to feel bad enough for committing fraud? And probably they won't do it, right? Let's first take a look at the incentive, okay? Incentive, the biggest incentive today for fraudulent financial reporting, like I explained, is called management compensation schemes. Right? If we look at it this century, you know that for average CEOs, on average, okay, if you look at their annual compensation package, over 80% is determined by stock market performance. What does this mean, right? You do well, there's going to be a big difference compared to if you report high performance compared to if you report low performance. So this gives people strong incentive to commit fraud, right? To polish the financial statements. Okay? Also, the incentive could come from financial pressure to improve the earnings or improve the balance sheet, which is the same thing, right? Also, something could be including debt covenants. What is debt covenants? Debt covenants is basically when companies try to borrow money from banks, right? Bank will say that, okay, I need the covenants. What are covenants? Those are a few terms. If you, as a borrower, violate, I have the right to take away the cash immediately. That's the debt covenant rules, right? So for example, a company, when they borrow from the bank want to keep themselves safe, so tell them that, hey, for us to keep the money with you, right, you have to make $1 million a year, right? But this year, your company make 900,000, what you gonna do? If you report, sorry, 900,000. If you report 900,000, the bank may take away all the loans and your company might just go bankrupt, right? So they give those companies some pressure, some incentive to commit fraud. And pending retirement or stock option expiration, they are basically the same. Personal wealth tied to either financial results or survival of a company. Greed, there is nothing to do about that. People are just greedy, right? Personal factors, pressure from family, friends, or culture, addiction to gambling or drugs. So personal factors, it's difficult to tell, but if we think about pressure from family, friends, or culture, you know that I'm Chinese, right? So I kind of understand this because probably I never watched, but I would imagine there's a movie called Crazy Rich Asians, right? I would imagine what that looks like, although I don't personally agree. I'm not rich enough to belong to that class, I guess. But you know that's a pressure, right? To make more money, right? People are wearing nice suits, right? We have you have some people have Louis Vuitton, and some people have the collaboration of Louis Vuitton with Supreme, so that's more awesome. I want that, right? And some people are wearing, for example, I know Apple Watch or Seiko or whatever stuff, right? But I know people like Rolex, those things, so I want it. You want it. Some people want to say, I work hard and save more to get it. Some people might just resort to fraud, right? So it's an incentive thing. And gambling, drugs, we all understand, right? But like I said, knowing those incentives, knowing those incentives for us is not enough, right? We have to figure out what to do about it. Right? I will ask you to think about it. If you are running a company, what would you do? Or what are policies you have seen that might be related to minimizing the incentives, weakening the incentives? I'll just give a few, okay, from the easy ones. I'll leave the hard one to you and leave the easy one to myself, all right? So let's take example. Addiction to gambling or drugs. You know, I'm not sure how many of you are, right? If you want to, I think if you want to apply jobs such as bank or some other like those companies transport cash, you know what I mean, right? I'm not sure what the name is, or financial companies, right? After your interview, everything, the company will tell you, give you a sheet, right? Hey, here's you go to do some blood work or urine work. Why? To examine whether you have addictions to drugs, right? And why this? For those companies, right? They touch cash, they deal with a lot of cash, and they figure out for people with drug abuse issues, right? Recreational drug abuse issues, right? They're more likely than other people to be running into money issues, and they are more likely than other people to commit fraud to do it, right? So as part of their policy, they set up this policy, right? So everybody who are applying for the job, they must take tests, screening tests, right? And also, even if people are in work, people are still concerned, right? Policy-wise, maybe when you're applying, you are not, or you did whatever stuff, so cheated screen, right? So even after people start their work, those companies might still give unannounced tests periodically. So this is a policy dealing with such issues, right? And also, we also manage, it's not listed here, but also manage being treated unfairly, right? I mean, if you recall our working environment, I think a lot of people would agree, right? There's always some nice guy who's quiet, does the job, but there's always another guy who's kind of knows how to talk about things, take credits, or we call them a kisser or whatever stuff. Everybody don't like that, right? So for companies, it's a real concern because for any supervisors, we are inevitably biased. Right? So how to reduce this? I mean, we are biased intentionally or unintentionally, right? We always favor the people we like, and maybe omitting those who really did the hard work. Okay? So it's kind of unfair, and then when this unfair is accumulated to a certain degree, we might see fraud, or people take whatever belongs to them. Okay, that's a rationalization part actually. Being treated unfairly is an incentive, right? Incentive thing. But then rationalization is I'm taking whatever belongs to myself. We can talk about later. So companies, what did they do to set it up, right? Back from the 90s, human resources, HR, psychology becomes a big part, and people come up with this thing called performance evaluation, right? Performance evaluation is try to do from a fair perspective, ask multiple persons to evaluate certain personnel's performance to minimize bias, to try to be fair. When I was working at KPMG, what we did every year was, because we have different clients every year, right? Every year we had a lot. So we have to do 3 performance evaluation. We write for ourselves, that's one. And then from our previous, that year's all the clients, we pick the team leaders, we pick 3 or 4, and they will write evaluation for us. And then our department head will write evaluation for us. And the HR department will summarize the 3 and give a evaluation score, and we will get a raise, right? Pay raise. So that's one thing to deal with it. And after incentive, we talk about opportunity, because if a company has a very good financial system, internal control system over financial reporting, they should not give people so much opportunities, right? And what we're taking a look at the opportunity is a significantly related party transactions. What is related party transactions is basically transactions that are not fair. We can say that for certain reasons, because the company says your brothers, or this is a parent company with subsidiary companies. And also companies' industry position, management inconsistency involving subjective judgments. Some people might look down upon accounting, right? I don't like it. Some management people might say that, okay, I want to be flexible, I want to be aggressive in marketing, so you just use whatever you want, as long as it's legit, and we don't need a strict approving, okay? Complex transactions, when transactions are complex, they give people opportunities, right? A very simple is we know kickbacks, right? We know kickbacks. So it's one example. Complex or difficult to understand transactions, ineffective monitoring of management by boards or by supervisors, okay? Complex or unstable organization structure, weak or non-existent internal controls. So what we are talking about here, basically we are saying that when the company lacks rules, and when the company, even if they have rules, they lack people to carry it out. They are giving people opportunity, all right? And we might go further later. I'm not going to spend too much time on opportunities, because internal control is mostly about killing the opportunities. What I'm trying to say here, if we think about it, right? Fraud is committed by human beings, okay? So as long as job is still done by human beings and fraud is inevitable, all we can do is we hope to have rules and to make the odds of fraud, make it leaner and leaner, right? And if we check all the controls in policies regarding opportunities, minimizing opportunities, they are boiled down to 2 things. One is called authorization, meaning that a certain level employee, they can do certain things without being authorized, but when it exceeds certain amounts, right, they have to be authorized, okay? A cashier may be able to approve payments smaller than 10,000. For anything over 10,000, they need to be approved by a supervisor, right? That's one opportunity, because for a cashier, normally, let's say people are not easily, cashiers are not earning the highest salary, right? So they might not be tempted by 1,000, but if we do not have authorization, when they are handling 10,000, 50,000, it might be a big temptation. Temptation becomes bigger and bigger, so that at a certain point of time, they might commit fraud, right? So one we said authorization, and then the other is jobs duty segregation, or people call it job segregation or segregation of duties. Basically, we are saying that one people do a job. Don't let them do jobs that could potentially be conflicting. Right? So if we look at the accounting departments, right, the financial team of a company, you never see somebody doing accounting work, certain accounts with cashiers work. Why? Because like we said, accounting work is to record transactions, including cash. And if there's somebody doing bookkeeping of cash and then handles cash, then basically this somebody get a those keys to the safe, can loot whatever they want, right? So when we talk about opportunities, it's basically like this, right? I'm not going to spend too much time on this. And the last, we have rationalization, okay? Rationalization, we said basically nobody, I believe, I still have good hope in human beings, so I believe no one wants to, be the bad guy. So unless they have to, and after that, they will try to make reasons for themselves to make feel better. Rationalization involves reconciliation, reconciling unlawful and unethical behavior. Rationalization for fraudulent financial reporting save a company, right? Rationalization for asset misappropriation is treated by the company like the unfairness we talked about and a sense of entitlement by the individual perpetrating the fraud. I'm going to talk a little bit about saving a company, right? So when I was an auditor at one time, I went to a small town. There was a client who basically was the biggest employer in town, and a lot of families of the small town relied on that. And when we are doing the accounting work for them, we actually realized there were certain issues with financial statement reporting because their earnings were overstated a little bit. But just by this little bit, they did not violate the debt covenant they had with the local bank. Right? And I checked this, the company was really not making a lot of money. I mean, makes money, but not a lot. And I don't see the owners, the management could benefit a lot from such, but keep in mind, that's a family-owned company. So for them, keep a family name, right? Keep the reputation, keep not feeding the town, but providing the town with jobs is related to the family reputation. So they want to keep it. So that we finally adjusted, right? But I have to say that in a situation like this, it's kind of difficult, right? Those who committed fraud, we didn't, it didn't really go to criminal level because we don't know whether it's a mistake or fraud. And because we caught it, we're going to talk about this, but so the company corrected, right? But I have to point out, like, don't make yourself to decide who should be saved or who should not be saved. Stick with your work. If this is what it is, then they should report what it is, right? Because if you think about it, right, the company, we said, okay, if you let them give it loose, some people committed fraud to keep everybody in place. But on the other hand, whoever look at their financial statements, right, or they are talking to lending them money, you might be luring them to make a mistake. Banks may be fooled, right? And if they lend money to a company they should not be lending to, or they are sending the interest rate that is too low for the risk, right? So if you allow such things to happen, banks might be closed and more other people might lose jobs. You see my point? So don't try to be the God or whatever judge here. If this is the rule, stick with it. Do whatever you are supposed to do. So what can auditors do? Okay, auditors, regarding this, how do we realize there might be fraud or not? So for example, one thing to make the company better, we all heard the terms about it. I don't want to explain too much, but the first one, pressure created for top management by the analysts, the following and earnings expectations. So one thing is, we know people, for publicly traded companies, right? We all heard the term audit analysts. Analysts basically, they follow companies, make earnings focus for the company, right? And what are stock price? Stock price are affected by those earnings forecasted by the analysts and by the earnings announced by the companies, right? So when the analysts are very optimistic about a company's future and announce good earnings, market price goes higher and higher. It also adds pressure to the management, to the company. Why? Because how to make stock price high, you have to be better than people think. If you're as good as people think, your stock price won't change. You have to be better. How to be better? Some people resort to fraudulent financial reporting. So when we are doing auditing, right, if we are saying that, hey, this company's performance seems to be just be over what people thought it would be, right? Or this company's performance just barely turned the profit, didn't lose money. So we can see that maybe those companies, there's a possibility those companies are committing fraud. Here's a COSO reports and analysis regarding frauds. You can take a look. And a video we can watch, it's about other anything, and we don't have to watch everything, right? And here are some ways to mitigating the risk of fraudulent financial reporting. Okay, for companies, what they did, and Sarbanes-Oxley, those things we can all take a look. And the next chapter, we're going to talk about internal control, and which is part of corporate governance, and hopefully it will give us some more ideas of how to reduce the odds of misstatements. All right, so this is chapter 2. Like I said, when I talk about chapters, I'm not a big fan of just reading through it. I like to rely less on slides, but sometimes doing an online class, it seems to I have to share with you those slides at a certain point of time. Again, if you have questions, don't hesitate to email me. If you see this, okay, yeah, I think that should be it. And I'll see you next time. Bye-bye.